Bloomberg Audio Studios. Podcasts, radio, news. This is Bloomberg Businessweek Daily, reporting from the magazine that helps global leaders stay ahead, with insight on the people, companies, and trends shaping today's complex economy, plus global business, finance, and tech news as it happens. The Bloomberg Businessweek Daily podcast with Carol Masser and Tim Stennebeck on Bloomberg Radio.
We mentioned some breaking news, if you've been listening just in the last few minutes, regarding the media deal that we just can't stop talking about.
Yeah, and that just can't seem to get done because it goes back and forth. Warner Brothers Discovery planning to reject Paramount Skydance's hostile takeover bid due to concerns about financing and other terms. Let's see what our Felix Gillette has to say about this. He covers the media space for us so closely here at Bloomberg. So I do feel like the back and forth. It's hard to really kind of read the tea leaves. What do you make about this latest reporting?
I mean, I think it's not entirely surprising, right? Paramount lost the initial round of bids and to Netflix, and then came out with a public hostile offer. But it was the same offer that the board had already rejected, essentially. So we're all essentially waiting for them to review it again, and then essentially say, oh, yeah, you know what? We actually did like the Netflix bid more, and that'll toss the ball back into Paramount's court. And I think they're going to have to come back with a better offer, more money, something in the way of addressing the concerns about financing that Warner Brothers board has had all along.
Does Paramount Skydance have that money? I mean, Larry Ellison's worth $240 billion.
Mm-hmm. Yeah.
$219 billion of that is tied up in Oracle stock.
Yeah. Well, I think there's questions that have not been addressed, even though the Ellisons have said one way or another, we actually did address all these concerns about the financing. Initially there was money from Tencent, which caused some concern. That was taken out, you remember? So there have been adjustments made, but I think at this point it's officially going to go back to them again, and they'll probably have to come up with something more, whether it's more money or whatever, addressing those concerns that remain.
I lost track in terms of, Felix, the Paramount Skydance deal, because it was Jared Kushner's investment firm, and there was, I think, some Saudi investors. And help me understand, because it feels like I thought that was a lot of the financial offer.
Like it was diversified.
It was a lot more diversified, and I felt like they were
of money to come in.
Well, they were ponying up. It felt like a lot of money, but I'm not quite so sure, because if Larry Ellison is still so important to this offer, is it a much smaller portion?
It was, they've made adjustments. So it's like, I think what the Warner Brothers Discovery Board is saying is they want more assurance that it's from Larry Ellison, that money feels, better from a regulatory perspective if you can get the money from the Ellison family versus these other sources that have been part of the financing deal from the beginning, such as the Middle East, Middle East money, money that from Tencent, like I said, that was taken out, Jared Kushner, which again might help with the White House, but might raise other concerns.
Yeah, I'm glad you brought that up, because Carol brought up just a few weeks ago what happened when Rupert Murdoch wanted to buy Fox, and what a challenge it was for him to do that because of foreign ownership of a broadcast network and the hoops that he had to jump through in order to do that. Okay, so I still have a lot of questions and unanswerable at this point about what this deal looks like. Let's just say, for the sake of simplicity, Netflix wins out. Yeah. Netflix actually gets these assets. Netflix gets HBO. You wrote the book on HBO. This is a wild world that we're living in if Netflix actually gets this. What does it mean for consumers? Is this good for us?
Well, Netflix would say, it's going to be great because ultimately it will lower prices. We'll have, we'll be able to be more flexible in terms of bundling.
Does consolidation usually lower prices?
That's a great question.
I'm just asking.
My streaming bill is pretty high.
I'm just asking a rhetorical question.
But I think
here.
You've seen a lot of voices in Hollywood raising concern immediately about Netflix winning this deal because it's going to be so much consolidation of power. Now, Netflix has said, really you have to look at the broader universe of people's attention. And now people are on TikTok and they're on YouTube and all these other things. But really, in the subscription video on-demand world, Netflix is already the market leader. If you add in all of these assets from HBO Max, they're going to have more than 400 million subscribers around the world. They're going to absolutely so utterly dominate the subscription video business that I think people are going to be like, there's going to be no one else to sell to, and that's going to be bad for the business overall, and ultimately it'll cost consumers more money down the line.
Yeah, that feels about right. Hey, why is this so difficult to get this done? Why is this one so difficult?
Well, I mean, people trying to, make these assets, more valuable from Warner Brothers Discovery for 20 years. I mean, you're going back to AOL Time Warner, which again was around the 2000s.
Yeah.
So, and then AT&T made a run at trying to make these assets work for them. Then you had Discovery come in. It's a challenge that has enticed so many different people and yet has always proven more difficult in reality than on paper for, decades now.
What's the risk that somebody overpays? Ultimately, I feel like there's been so much in terms of media assets, and we know the media landscape, better than most, how it continues to change and evolve. So I'm just curious.
Well, I think the idea is you have the biggest library, you have the most selection for your viewers. It's going to drive subscribers. People are going to engage with it. You're going to, have more subscribers coming in. But the problem is always, how do you arrange those assets? How do you arrange those shows and movies on a small app in a way that's enticing and available? I mean, I think the problem that Discovery has had with Warner Brothers Discovery is that, piling in all these reality shows into HBO Max didn't actually increase engagement at all. In fact, it just kind of a lot of those shows and programs just get lost in the mix and no one watches them. So that's the problem, is you end up paying for a bunch of things that don't actually drive engagement.
Well, here's this: Jared Kushner's Affinity withdrawing from the Warner Brothers takeover battle.
Yeah. Okay, I mean, again, that would make sense. It would lower some of the concerns from state attorney generals, anyone that is worried about what Paramount and Ellison's would do with things like CNN.
So that makes Paramount Skydance's offer more attractive to Warner Brothers Discovery?
I think it makes it simpler and thus a little bit more attractive in terms of, again, if you're willing to if Larry Ellison will just put up the money and backs up this whole thing, that's the easiest way for them.
Have you seen Oracle's share price lately?
So much of his wealth is tied up in Oracle.
With Oracle.
He only has $20 billion only, but he has basically 18, according to the Bloomberg Billionaires Index, basically $18 billion worth of net worth that is not tied up.
Wait, so go
Oracle.
back to this headline that just crossed: Jared Kushner's Affinity withdrawing from the Warner Brothers takeover battle. That, you say, makes the Paramount Skydance potentially more attractive?
From the Warner Brothers Discovery Board's perspective, potentially. Although at the same time, it's a two-edged sword, because then it's also, will that make it harder for the regulatory approval down the line in terms of getting approval from, the Department of Justice in Trump's White House? Will they, without the son-in-law involved, does that make it harder? I mean, I think there's a lot of questions on both sides of this, and it's going to continue to play out in the weeks ahead.
Okay, so one question that we have is about the global linear networks, because Netflix's deal does not include CNN, TNT, Cartoon Network. I mean, the list certainly goes on when it comes to these assets that not that many people really want right now.
Yeah.
What's the fate of those if Netflix wins this bid?
Well, they'll be spun off into a separate company before the acquisition takes place.
Like a publicly traded company, separate public company?
Traded company, Discovery, probably called Discovery Global. That's the plan at this point. Those assets are still throwing off profits, but the viewership is declining across the board. There's a lot of other cable networks out there, right? Comcast is in the process of just spinning off a bunch of its traditional cable assets. So, at some point, does somebody come along and roll all of those assets into one company? There's probably some, synergies if you combine them all in one place. But it's managing a declining asset over time.
I just want to mention, because a Bloomberg story just crossing, so Jared Kushner's Affinity Partners exiting from the takeover battle for Warner Brothers Discovery. A representative for the firm said Affinity They say they now believe the dynamics of an investment have changed since it became involved in the process in October. Here's a quote. With two strong competitors vying to secure the future of this unique American asset, Affinity has decided no longer to pursue the opportunity. We continue to believe there is a strong strategic rationale for Paramount's offer. I don't know. Right?
Well, I mean, that's the thing is I think when you put Jared Kushner in the mix, on the one hand, again, you think, oh, maybe it'll improve their ability to get it through regulatory concerns faster under Trump's administration. On the other hand, it raises all these other political objections from, progressive states, including California and New York, where a lot of entertainment assets are located. So, there's definitely problems involved too.
Well, even without Affinity partners, Paramount's offer is being bankrolled by a list of influential Middle Eastern investors, Saudi Arabia's Public Investment Fund, Qatar Investment Authority, as well as a little-known group from Abu Dhabi called Limad Holding Company. Kushner does have strong ties to the Middle East. He founded Affinity in 2021 with funding from sovereign wealth funds from the region. Carol, as you say, it's complicated.
It's complicated. This one is, which means we'll be coming, because it ain't over yet either.
It's not even close.
Felix Gillette, thank you so much. So appreciated. Felix, of course, covering the media space for us. As we said, wrote the book on HBO.
Yeah, the book, It's Not TV, The Spectacular Rise, Revolution, and Future of HBO. Get that book now if you haven't read it.
Felix
already.
is a media and entertainment editor, so thank you so much.
Stay with us. More from Bloomberg Businessweek Daily coming up after this.
You're listening to the Bloomberg Businessweek Daily Podcast. Catch us live weekday afternoons from 2 to 5 Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
We're going to stay on the macro with a financial sector emphasis. And great to have back with us Chris Whalen, chairman of Whalen Global Advisors. He worked at the New York Fed in the 80s. He's testified before Congress and the SEC, worked on Wall Street. I forgot that you worked at Bear Stearns and some other written many books, and also served on the Economic Advisory Committee of FINRA for over a decade. And you also were a consultant to Billions, was that right?
Yes, it was great fun. They were buying a bank.
They were buying a bank and they wanted to know?
Yeah, they were trying to, finagle the regulators. It was a typical Billions kind of script.
Well, out of the entire resume that Carol just mentioned, was that the most fun, working on Billions?
No, I think the most fun was early days working at Bear Stearns in London, selling bonds. That was a lot of fun. We had a blast.
Well, tell us about, it's funny, I love talking with someone like you because you have seen just kind of how the financial sector has changed a lot, Chris, right? And the stress points that we've seen, certainly the financial crisis and elsewhere. When you look at, we just talked with Mike about some of the macro backdrop, and we've talked with you about specific risks, but does it feel comfortable today, kind of the environment, in your view, compared to what we've seen in the past?
No, I was going through the third quarter numbers for the big bank holding companies, which the Fed just released. Yeah. Day 75 after the quarter close. That's the best that they can do. And it's eerie. The credit costs are trending down. Asset returns, thank God, are getting back to normal, about 1.5%. But there's a lot we don't see. And that's what's worrying people. Whether you talk about Oracle or you talk about private credit, what people are worried about today is what they don't see in the data, because they know that a lot of this is being fudged. And that's what worries me as well.
What do you think is being fudged?
Things like loan losses. There's a lot of forbearance here in New York City for multifamily apartments. Our new mayor is threatening to start taking over buildings that landlords are not keeping up to his standards. Well, the city of New York can't afford to take care of them either. And so we have this accumulation of pressures, mostly caused by inflation, mostly caused by our friends at the Fed. But in their defense, why did they do that? Because we told everybody they didn't have to pay their loans and their rent for 2 years during COVID. People forget that in the mortgage industry in March of 2020, we were all looking at one another going, what are we going to do? This is after President Trump declared the emergency and said, you don't have to pay your bills.
Yeah.
Well, the Fed came to the rescue. By dropping rates to zero, we caused a surge of home lending activity, record volumes, and that float was borrowed to help everybody pay their bills.
So why aren't we seeing more stress in the credit markets, and why are we seeing records on Wall Street? And it sounds like then some disconnect.
I think part of the reason that the street has been doing well, listed stocks, is because you have a lot of liquidity coming out of private markets, going back into more liquid markets. Makes sense, right? Private equity, private credit is a mess. And we all know this. Something like 15% of private equity companies in the U.S. are paying in kind rather than in cash.
Right.
So you know
we keep waiting for the year to like the exits and for things to move on.
There's a lack of demand from banks for loans except in one category, non-depository financial companies, which is another way of saying private equity funds, credit shops like Ares and Apollo. They're the ones that have been aggressively expanding their business, using money in part from banks. So the banks are now the facilitators. And what does this remind us of, Carol? The 2000s.
Right.
It's the same thing. You have non-bank intermediation relying on the bond market, equity markets, and bank credit. And the thing is, eventually they're going to stumble. And that's what everybody's worried about, I think.
So what does that stumble look like? What is the shoe that drops?
It looks like First Brands. Hello, we're defaulting. And most people had never focused on that company. It was a private, totally institutional play. The same thing with Tricolor. Auto lender that, half of their customers were illegal aliens. Nobody had ever focused on this. It was an institutional story that suddenly surged.
So you think
consciousness.
You think those two instances are canaries in the coal mine?
I think they are typical of what we're going to see more in the future, which is you're going to see more of the missteps in the institutional non-public market, which was supposedly better. Remember, everybody was selling us the idea that private was better than public? No, we have public markets because they were open and relatively liquid.
Chris, after the Jamie Dimon cockroach comment, that there were many members in the private world that came out, or a few, I should say, that came on our air, and that seemed to say, hey, listen, things are fine. And I understand many would say they're talking their book, but, are they systemic risks? Like, what's the exposure with the traditional financial sector when it comes to the private markets? Because I think that's what we care most about, right?
No, I think the private players can fail tomorrow. It will cause a bit of kerfluffle and volatility in the markets. But are they systemic like a big bank? No. But the big banks will take their lumps too, because they are lending indirectly into these structures. They tend to take the most senior positions, but that may not save them. You see, the assumption that, okay, I'm senior and 3/4 of the stack is below me, and therefore I'm okay, that may not work this time around because you have leverage on leverage on leverage in some of these deals.
So when like the big banks report again, we're getting ready for another earnings cycle, right? We'll get that, in early January. So what do we look for things like that? Like, what do you look for?
The numbers are going to be wonderful. That's what worries me. Just as an analyst, we were supposed to have a recession last year. Credit losses largely peaked last year, third, fourth quarter.
Yeah.
They've been coming down since then. So if you look at the picture, you say, God, everything is great. You don't see a lot of utilization. You don't see a lot of demand from the banks for credit. They've got a ton of unused credit out there that they wish people would use. But so you don't see stress in the published numbers. Where you see stress is when you talk to professionals, when you read the really interesting media like Bloomberg and others that cover some of these stories. There was a great piece in the FT over the last week talking about Altus, a company that Jamie Dimon came to the rescue of, paid off their most restrictive loans so that they can go out and borrow more money.
So
and all the credit guys that you're talking about looked at Jamie Dimon and they're going, hello, what are you doing?
Yeah.
So he's an enabler of bad behavior because Jamie has to go out and make money too in a market where there isn't a lot of, what I would call quality demand.
Which reminds me of what would happen in the great financial crisis, of people saying, I know it's getting messy and ugly, but there was the CEO of Citi at the time, I think, who came out and made some comment about, I got to be in it.
Oh, no, that's right. Yeah, that was the
I can't think of
the temporary CEO who replaced John Reed.
But I'm just saying, this idea of feeling like you have to be in it, the pressure of it.
Yes and no. I think that some institutions have the common sense to pull back and say no.
Yeah.
Others don't. I'll give you an example. PNC. PNC has the lowest loss rate in the top 7 banks. They've also got one of the lowest funding costs. That's a fairly well-run $500 billion bank that has managed to avoid risk, I think often by saying no. The street wanted them to get more involved in certain things like prime brokerage, dealing with private equity funds, that sort of thing.
Right.
And they said no. So I think there are institutions that are very well run in this market. But again, the banks are underutilized because the non-bank financial companies have stolen their march, and they're going to the customer, and they're using wholesale funding from the big banks, and they're in turn disintermediating them at the same time.
Chris, we want to talk a little bit about AI too in the time that we have left. We've talked about it with you before. Circular financing, we're not sure how it all plays out in the economy and what it has to do with productivity and with economic growth. Weighing in on AI and its potential economic impact, Ken Griffin of Citadel, speaking with Bloomberg's Danny Berger a little earlier today at a conference in Paris. Check out what he said.
I think there is some chance that we will see meaningful progress in this field that will change the calculus that I'm setting forth. Like, there are so many bright people in their 20s and 30s trying to unlock true intelligence, that this does create the environment in which a breakthrough may happen. But I think that generative AI, as we know it today, will have a very pointed but relatively limited impact on the broader economy.
A pointed but relatively limited impact on the broader economy. Ken Griffin of Citadel earlier today. What, in your view, is the impact of AI on this economy?
I think it's incremental, better search tools. You know, we're writers.
So is he right?
I think he is right. And frankly, I read a lot of the long-haired stuff on AI, some of the people in the scientific community, and they tell you the same thing, because this is a third or fourth, fifth time that we have talked about AI. You go back to the 70s and the 80s.
It's not new.
Remember Watson, IBM, which was a fiasco. But it was their way of showing what new technology could do. But is it creating general intelligence? No.
So is all this a waste? Is all this a waste?
No, it's marketing. You know, never.
Yeah, but that's a lot to spend on marketing.
But the spend, yeah.
But look, everything in the U.S. economy is about marketing, okay? Doesn't matter what it is. And if it's attached to a stock, then you know it's marketing. NVIDIA. I've made a ton of money on NVIDIA. I'm very grateful to Mr. Wang. But is he going to change the world? No. What we're doing is building a lot of infrastructure. We're spending a ton of money, not so much on building AI, but preparing to have the capacity to do it, mostly by studying the past. To me, that's not AI. AI is when a machine can start to observe what's around it and react and determine what to do next based on what it sees, not because of, it's studied our language for the last 50 years.
So you're like the whole idea of AI is all the data that's put in from the past. You think that, okay, that's your take.
It's all we have.
Well, are you still in NVIDIA?
No, I got out. I wrote it up. It split. I wrote it up again. It split. When it gets to be a third of my portfolio, I've got to take the money and run. You know, with all due respect to Jim Cramer, who I'm very grateful to for getting me into that stock.
But it sounds like you're saying that we're in a bubble, at least with the spend.
Of course we are. That's what humans do. That's what markets are about.
So what happens when this bubble...
We follow the shiny object.
What happens when the bubble pops?
We're going to see that a lot of the spend for AI will not be compensated with revenue growth that's going to help to pay it off. And Oracle, I think, unfortunately, a great company, is the poster child for this. They were following the crowd. Mm-hmm. They decided to double down and do even more. And the truth of the matter is, one, large language model, if all of the tech companies had gotten together and said, look, let's do this together. Right? But the other problem, I think, is the metaphors that we use in this conversation, this race with China. The Chinese don't use metaphors like that. When you listen to them talk about AI, it's part of a broader range of initiatives that they're trying to use to give them an advantage in the global economy. They don't see it as a race. This is all marketing hype. And we have to differentiate between the technology and the sell, okay? Yeah. It's like we used to say about IBM, never mistake sales with, delivery. No.
All right, we got to leave it there. Thank you. Really appreciate it.
My pleasure.
Chris Whalen, chairman of Whalen Global Advisors, joining us here in studio.
Stay with us. More from Bloomberg Businessweek Daily coming up after this.
You're listening to the Bloomberg Businessweek Daily Podcast. Catch us live weekday afternoons from 2 to 5 Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Hey, we talked about the market, the U.S. jobs market earlier with Michael McKee. It's sluggish, not rapidly deteriorating. And we did see that data that came out, saw traders refraining from boosting bets on near-term Fed rate cuts, setting stocks lower and bonds wavering. So we're not, it's not like all of a sudden traders are saying, okay, we're going to get more rate cuts because of that labor data we got this morning.
Yeah, a reduction is fully priced in by mid next year. Yeah. We should know, but we're not seeing those bets go up.
No, exactly. Curious to see what our next guest has to say specifically about the U.S. labor market. Let's head to the Bloomberg News Bureau in D.C. to someone well known to our Bloomberg audience. She was formerly chief economist over at ZipRecruiter. She is Julia Pollack, and she's chief economist for the U.S. Department of Labor. Julia, good to have you back here on Bloomberg. How worried are you about rising unemployment?
I'm not. So this report understates the strength of the labor market right now because there are two huge temporary distortions at play in the data here. The first is 100,000 or more federal workers who took the fork and came off payrolls, and some of them have gone into temporary frictional unemployment. And the second big distortion in this report is the Schumer shutdown, which forced 900,000 federal workers off the job, but it also led to weakness in the private sector because it forced work stoppages for federal contractors and led to temporary layoffs there. So I expect the unemployment rate to jump back down very soon.
What about the youth unemployment rate, the rising youth unemployment? Are you concerned about that?
So, the unemployment rate is exactly where it was when President Trump first took office in his first term, and he has a track record of bringing it all the way down to 3.5%. We have a bigger challenge this time because of the Biden inflation hangover, which forced the Fed to slam the brakes on the economy, and that has hurt marginal workers the most. But we are setting the stage for a huge comeback in 2026 and beyond with the One Big Beautiful Bill Act, which has hugely stimulative policies. And you'll see those macro stimulative effects build into 2026. They are things like expensing, fast and accelerated, full and accelerated expensing for business investments, no tax on tips, no tax on overtime, no tax on Social Security.
So, Julia, if I may just jump in, just because we only have about 5 minutes left here. So it sounds to you like that there's, and we've heard this certainly from guests here on Bloomberg, more liquidity coming into the market, things to support economic growth. It sounds like you said that the labor picture is actually better than what the data showed. So it sounds to me then that the Fed is correct. Jay Powell is correct in being, actually, forgive me, what you're sounding like you're saying is that maybe the Fed doesn't need then ultimately to be cutting rates, that things actually look pretty rosy for 2026.
So I think the reason that employment growth, the job growth slowed so dramatically between mid-2022 and mid-2024 is that rates were high, and the longer rates stay restrictive, the more of the economy gets hurt. The more businesses have to refinance at double the rate, the more families go out there and try to buy a home and find that it's just unaffordable. So rates right now are still restrictive, and they are still a problem for much of the economy.
But you said you weren't concerned about rising unemployment. So I'm a little confused.
Well, the Fed has a dual mandate: full employment on the one hand and price stability. And this president has shown that his policies deliver both. In the first Trump administration, we had non-inflationary growth, and you can do that with policies that don't throw fuel on the fire of demand and restrict supply, but do the exact opposite. So through deregulation, through reshoring incentives, we're going to see this labor market take off again, and in a non-inflationary way.
Well, on the reshoring part of this, a motivation for reshoring, onshoring, imposing tariffs to bring back the Midwest, to revitalize what many consider the American dream. Secretary Bessent has said it's been harmed by global trade. The manufacturing industry, though, it keeps shedding workers. When can we expect the data to reflect progress that the administration is trying to make in restoring that American dream?
So the economy shed manufacturing jobs for about 2 years before President Trump took office again. This latest report shows the largest increase in construction jobs in over a year. And that's really the front end of those investments in mining, in energy, and manufacturing. And they're a signal that manufacturing job growth will pick up.
So, okay. You look at the labor market, I mean, in terms of initiatives that will potentially help the U.S. labor market. The conversation around artificial intelligence. Fed Chair Jay Powell even addressed it in saying it hasn't impacted U.S. jobs yet. So I'm just curious, how are you factoring that into as you look at some of the upcoming moves? The president ramping up in terms of hiring people to really focus on technology, AI specifically in the administration. So looking to make more investments so that the U.S. certainly has a dominant role. I'm just curious how then you factor that into your estimates for the impact on the U.S. labor market.
Well, the AI boom is driving huge demand for workers in the skilled trades, in advanced manufacturing, and of course, workers with AI skills. And it is our job at the Labor Department to ensure that U.S. workers are prepared for those jobs of the future. For the first time, labor policy and education policy are pulling in the same direction. We've aligned labor and education for the first time ever, and we are now focusing very heavily on getting workers access to job-connected training that sets them up for in-demand jobs and that doesn't push them to expensive degrees that leave them with nowhere to go.
Let's talk personnel a little bit. We're curious about why it's taking so long to make another nomination as BLS commissioner. Is your name in the ring? Is your hat in the ring?
I have no idea. You'd have to ask the president that.
Would you, if you were asked, would you serve as that?
Well, I think there is a tremendous amount of work to do there, tracking AI's labor impact, improving the timeliness, the granularity, the accuracy of the data. And I have, at the Labor Department, made it my priority to push forward a very aggressive labor market data modernization agenda that puts workers and learners first and gives them more access to the data collected on them. So right now, I love partnering with the BLS on all of those kinds of initiatives, and I am happy to serve in whatever role the president sees fit.
If we're thinking just 30 seconds, but if we're thinking about previous commissioners, how will this nominee or this next commissioner be different? Just 20 seconds.
I have no idea, but I think that whoever comes in has a very clear mandate from the president to put workers and learners at the center of what we do, to change the data paradigm to a real-time data paradigm, and to make sure that the data is accurate and has the utmost integrity.
All right, Julia, thank you so much. Julia Pollack, Chief Economist for the U.S. Department of Labor.
Stay with us. More from Bloomberg Businessweek Daily coming up after this.
You're listening to the Bloomberg Businessweek Daily Podcast. Catch us live weekday afternoons from 2 to 5 Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
I've been driving all night, my hands wet on the wheel.
Come on, let's take a drive.
A drive?
Yeah, a drive.
Can you just focus on driving? Focus on the road.
Why would I drive fast?
Because I'm asking you to.
Just take your place in the driver's seat. Just drive, baby. Driver's seat.
This is the Drive to the Close.
Where we're going, we don't need roads.
On Bloomberg Radio.
All right, everybody, we are just about 18 minutes away from the closing bell on Wall Street. Carol Massar, Tim Stanovic, live across Bloomberg platforms here at Bloomberg headquarters. And we're seeing some buying as we get closer to the closing bell here. And I'm just looking at you've got an S&P 500, though, that's still a little bit lower down, about 5 points here, but definitely off its worst levels of the session. NASDAQ 100 now 107 points to the upside, Tim, and that's good for a gain of about 0.4%.
All right, let's bring in Larry Pitkowski. He's co-founder and managing partner and portfolio manager of Good Haven Capital Management. He joins us here in the Bloomberg Interactive Brokers studio, in person, in the flesh.
In person. It is nice to be here in the studio with you both.
I think it's been many years.
Last
since we
time?
saw you.
It's been a long time. You know, every
Pre-COVID?
time we do this remotely, it seems like the two of you are having a lot more fun in the studio than I am in my office in New Jersey. Plus, you have the unlimited snacks, you know, in the lobby. So I figured, well, what the heck, I'm coming in.
You're welcome anytime. And thanks for braving the cold for coming in. Hey, we want to talk about Berkshire Hathaway. We want to talk about Lennar. But I want to talk about the macro economy and sort of what the outlook looks like for 2026 and what the market environment looks like for 2026. How are you thinking about the new year and asset allocation?
I am thinking that the market, there's plenty of pockets of the market that are expensive. The market overall is certainly not cheap. The economy seems okay. And I have the luxury, which I have it a little easier than you folks. You have to, you know, every day, every minute have a somewhat of a thoughtful conclusion on everything. I have the luxury of saying...
Oh, you are so wrong about that.
I have the luxury of saying, I don't know.
People who disagree.
I don't know. And nobody's yelling at me if I say, I don't know. So I look at the landscape and say it is what it is, but we've been fortunate at Good Haven to be able to, you know, keep turning over rocks and finding things that are undervalued, and I think the portfolio itself is attractive.
Is it still hard to be, you're a value mid-cap player. Is it still hard to be a value player? I'm looking at the fund, up about 8% year to date. 3-year, we're looking at average annual returns of almost 20%, which puts you in the 97th percentile. 5-year, about 16% on average annually, according to Bloomberg data, 98th percentile. So longer term, some really outperformance there. But is it harder right now to still be?
It's always hard. It's always hard, and you, if you want to outperform over the long term, you can't outperform over every period. But it's always hard. But you should enjoy continuing to look under rocks, and you should expect, as I've written to people for a long time,
Right.
you know, there's periods of, you know, the 3 and 5 year, which you call out, which we appreciate, are you know, numbers we're proud of. And, you know, we think the portfolio is set up very nicely on a go-forward basis. But it's always hard, but it's always also interesting, and it's never boring.
Okay, so let's talk about some of these individual stocks. I want to start with Lennar and the opportunity that you see with Lennar. It's one of the biggest holdings in the fund. Why are you bullish?
Coming out of the great financial crisis, it appears that we have still been undersupplied in single-family homes. You can believe whichever statistic you want. Is there 2 million undersupplied, 3, 4, 5? And so,
isn't that amazing how we went from oversupply and empty homes to undersupply?
Well, you know, you
left
go,
brain, right brain doesn't work there for me. But
usually go to other extremes, and sometimes they stay there, and everybody remembers how bad that period was.
Yeah.
But the other interesting thing, you know, there's so many fast-changing parts of the economy out there. And at Good Haven, we often say to ourselves, wait, what's not changing? What industry might not be changing that fast that I could have a strong view of what it might look like in 3, 5, 7, 10 years? Single-family housing, Lennar is the second biggest builder after Horton.
And it's a lower price point than some of the competitors,
too. Well, it's a $400,000 price point. But, you know, so are, you know, Horton, Pulte, you know, or a lot of them are in that range. Total is $1 million. But the industry, and Lennar, you know, I think is leading the way, is becoming what we would call a better business. Higher returns on capital, higher returns on equity. They have taken what was a historic balance sheet that had a lot of land, and they've spun that out. So, and they're now repurchasing shares in a material way. And I think your timing is very good to have me on to discuss this, because they report earnings after the close today.
Right.
The near term, we expect to be somewhat tepid. That's an opportunity potentially. So you have a business that now has the ability to earn high returns on capital, repurchase shares. The price earnings multiple, maybe they earn around $8 for a little while, but the opportunity is that if they embark and continue to succeed in the strategy they've embarked on, you could imagine earnings at $20 or so a couple of years down the road as margins return to 2024 levels. Units are up 5-6%, you know, a year on average, and the share count comes down.
why are they in a position to show and get better return on capital, higher return on capital?
Because
what is
they've
it
spun
specifically?
out, because they've taken a balance sheet which had a lot of land, and they've spun that out into a company called Millrose, and now they've got a leaner balance sheet, okay, which gives them the ability to have higher returns on capital. They're not tying up so much capital in land, okay, and they also will generate free cash flow throughout the cycle. The industry was a little boom and bust historically when things, you know, they didn't really generate cash except when they shrunk. And so here is, and this is a very well articulated, well thought out plan. Again, the near term should be a bit tepid, but so what? I think you're creating a better business model for the long term.
So Larry, it has more to do with their strategy versus a lower rate environment, or people finally getting off the fence and buying homes. Or is it a little bit of everything?
Strategy, but I think the bigger players in the industry are in different ways embracing becoming better businesses. And the other interesting thing is that if I gave you $100 million and I said, go compete with Lennar, with Horton, with Pulte, with NVR, with Toll, I think it would be very hard to do so. I think these companies, the new home market has taken share from the existing home market because they have levers to pull, they have leverage in buying supplies and operating and marketing.
So hard to be a new entrant.
It's hard to not admire where they're going.
Before we let you go, we got to get you to weigh in on Berkshire Hathaway because it's your top holding in the fund. Greg Abel takes the reins next year. You're okay? You're keeping all your shares?
We are for sure keeping all our shares. We made Berkshire a very big holding in the COVID era. Our returns since then have been strong. This is a management team and a board with decades and decades of success. I think it is appropriate to assume that Mr. Buffett and the late Mr. Munger, after 60 years of great decisions, have made a thoughtful decision on succession, and you have to admire how well it's been laid out and articulated in a selfless way. Mr. Buffett is stepping aside and letting Mr. Abel write the letter, be on the podium at the meeting, letting him really, run
eat the
show.
candy,
right?
If he wants.
Let him run the show. So we admire how it's been done, and we think it's the kind of thing where you should give them the benefit of the doubt that it is a sensible and well thought out plan, which we do.
Well, fun to have you in studio.
Great being here.
Yeah. Come again sooner.
Okay, I will.
We would love it.
And help yourself to any snacks upstairs.
I'm going to load up my backpack. Old school.
You're not the only one to do that.
Old school.
I love
You're
the
in good
popcorn.
company.
I love the popcorn. Larry Pitkowski, co-founder, managing partner, portfolio manager, Good Haven Capital Management, right here in studio.
This is the Bloomberg Businessweek Daily podcast. Available on Apple, Spotify, and anywhere else you get your podcasts. Listen live weekday afternoons from 2 to 5 p.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.